welcome to Stock Markets with Bruce, the most unexciting show on YouTube. Am I getting richer today or not? And if I am, by how much? Those are simple questions, and I try to answer them in a simple, straightforward, plain English kind of way. The number one stock that's not having a good time is Netflix. Have you seen what happened to Netflix last night? Those of you who don't know, a lot of public companies will release their financial results, their current quarter or their year end, whatever it is, right after the market bell. So just after, I guess, what is that, 4 o'clock Eastern time? Whenever the markets close up for the day, they will then, within the next 15 minutes, release their latest financials. And in the case of Netflix, they released their financials and they beat on the top line, which meant that they brought in more money than analysts thought they'd bring in gross. They beat on the bottom line, which means they made more money net profit after all expenses and taxes than analysts had predicted. And so right there, you're going, oh, wow, that's fantastic. Way to go. Way to go, Netflix. Hey, beautiful. Nice job. This should be good for the stock, shouldn't it? Yes, it should. Except then they came up with their other little number. And that other little number they came up with was the number of subscribers that they added to their fold in the last quarter. And it was the slowest quarter in years. It was about 1 million new subscribers instead of the expected 4 million. And they did not deliver on new subscriptions. But I can tell you why they didn't deliver on new subscriptions. It wasn't because we don't like the service or anything like that. That isn't the problem with Netflix. What the problem is that they raised their prices. Last quarter, they jacked up their rate and they're charging more money per month than before. And I think a lot of people said, screw you, we're not paying it. And people dumped off. And my hunch is that they actually added 4 or 5 million new subscribers. Yeah, they did, but they lost 3 or 4 million subscribers as well. And that is not being openly discussed, but the stock is reflecting that. And therein lies the little surprise. Who's the president on a $50 bill? Is it Grant? Yeah, it's Grant, right? The President Grant. So the Netflix stock is down a Grant today. One big old $50 bill. Zzz is what we reach. We call that in the old brokerage business. Zzz, a little. Hi, how are you? We just down 10% right there, like that. Boom. That's a little wake-up call. And of course, what does the company do? They're trying to find a way to negate the drop. They're trying to find a way to convince the street, we're going to make it better. And for shareholders, what they're doing is they're announcing a $5 billion stock buyback. That's what they're announcing, which to me sets off alarm bells. I don't like it when companies announce stock buybacks when they're trying to maintain their high-priced stock. Because here's the reality of the situation. The company's shares yesterday at $5.49 were trading at 90 times earnings. I don't want a company that I'm a shareholder in buying its own stock back when they're trading at 90 times earnings. I want a company to buy its own stock back when it's trading at 9 times earnings or 11 times earnings, and the company feels they should be at 20 times earnings or 15 times earnings. I don't like to see a company putting $5 billion into their own paper when it's at 90 times earnings. That is a problem for me. It is an alarm bell for investors that you should understand. And again, this is Bruce in plain English trying to explain how the market works. Just read an article about Sherman, the departing CEO, and how the departure has been a negotiated departure from whatever I'm reading, that it has been amicable. But the reality is that Mr. Sherman, because he's volunteering to, I guess voluntarily leaving, without putting up too much of a fight, is being paid out by the board of directors. And this is common to negotiate this kind of deal. The deal is that he is going to be able to, in effect, walk out the door with stock in his hand that is vested. In other words, is earned stock that he can do whatever he wants with. And it is likely that his stock is worth almost $200 million when he walks out the door. And I should actually clarify this. I will clarify this. The article I read talking about it, an analyst was saying, oh, it looks like in the last year of his employment, he'll have earned $178 million, which is one of the highest payouts of any CEO in the world. Okay. But in reality, it's a severance package, and it's a severance deal in that the company is saying, leaving the company, you're leaving behind $100 million worth of stock that you're not going to get because you didn't hit certain parameters. We talked about that a few days ago. But in lieu of that, and in lieu of you leaving early and not putting up a squawk with us, we'll let you walk out the door with your stock in hand. And I think he's going to walk out the door with over 2 million shares owned in the company. And that means he's walking out the door with over $300 million of stock. He was, in effect, taking over a failing brick and mortar company. He was supposed to turn it around, and he was in the middle of doing that when a pandemic broke out. He was one of many CEOs, thousands of CEOs of publicly traded companies, who found themselves in the middle of a virus that they had no idea was going to come their way and upset the entire apple cart for everybody. The really good thing he did is what he didn't do. And again, this is where it's hard to credit him. And the street that hates GameStop is not going to credit him. But what he did not do is he did not dilute his shareholders to keep the company alive. He didn't do that. He maintained the 70 million shares outstanding. He cut costs. He lowered inventory levels. He figured out ways to keep his businesses operating, even though the stores were closed. He figured out a way to keep the operations going by having curbside pickup, having staff in the stores without the doors open, and fulfilling orders from online to allow curbside pickup. A very good thing. And the gamers out there who wanted to acquire merchandise from GameStop could still do it by ordering online and driving by their local store. They would be told by GameStop, pop by the store at this shopping mall and we'll have the merchandise for you. And he was also aware and became aware of a Mr. Ryan Cohen, and met with Mr. Cohen and went and gave, the two of them put their heads together and figured out there is a future for this company above and beyond the future that Mr. Sherman had been told to create. He had been given instructions by his board of directors what to do and how to do it. And now he is shifting this over to Mr. Cohen, which is a complete shift of management. And Mr. Sherman will leave the company in a very good financial position. For his pride and his personal self of accomplishment, he may feel that he wasn't able to deliver on the final result that he wanted to deliver, but the world has changed dramatically in the last year, and he had nothing to do with it. It's a virus that changed the world, not his management style that changed the world. And so he exits by this summer. He will stay on the board of directors, I'm told, in an advisory role. He's not going to be paid for his advisory role. And so I think my guess is that he will gracefully step aside, allow the new guys and kids to come on in. He'll be there for as long as he's needed. He'll then slowly exit. He may become a retired individual, or he might just become a consultant for hire for other companies for whatever they need, if that's what he wants to do. But in reality, does he need a job anymore? No, he does not. He can live off of his $300 million of stock, and that's assuming the shares stay at $160 a share. What if, just suppose, the shares go to $1,000 a share, and he's sitting on $2 million? The guy will never have to work ever again, of course. And so, well done to everyone. Well done by GameStop. Well done by management of GameStop. Well done by Mr. Sherman. And well done for all of you shareholders of GameStop. There is no controversy and there is no ugly divorce situation happening here. GameStop does not have to spend millions in legal fees, or Mr. Sherman spending millions in legal fees to part company. It's amicable, it's working out, and it's all good, and we can turn the page and move forward. And for those of you who are GameStop shareholders or thinking of becoming GameStop shareholders or wondering if you should, the news coming up will be the new CEO. We're waiting for that. And the first quarter financial reports, we're waiting for that. That should be out by about the end of May. And so we're only about 5 weeks away. And we're now, 9 days away from the end of the first quarter. End of April is the end of the first quarter. By the end of May, we should have the numbers. And we've already it's already been indicated to us as of a month ago, roughly, about a month ago already, 19th of March and March 22nd, 23rd. So about a month ago, we found out that the first quarter numbers are higher than last year already for the first and second month of the first quarter of the year. So good sounding numbers there, good sounding momentum, and the company is rapidly evolving into an e-commerce player. So, okay, we'll watch for that, see what's going on. Again, thank you all of you for being here and asking these questions. I appreciate it.